Good day, traders. Welcome to this week's Sunday Trader Talk Radio, first Sunday of the month. I trust you've all had a good start to the month, and by a good start to the month as price action traders, just two components to that. Are you sticking to your strategies, your price action strategies that you're trading, and are you sticking to your capital allocation and capital management model? If you are sticking to that and bringing that all together, you ought to have had a good start to the month. Now, my name is George, for those that don't know me, and for lack of a better descriptor, I describe myself as a reversals trader. I specialize in trading reversals into a trend. And when we have a strong trend, and you get a pullback in that strong trend, and the market is going to reverse again back into the trend, that's where I primarily look for my patterns as a reversals trader. My capital allocation and capital management model is structured on the reality that the probabilities of success, 40% of all my trades will be successful and they'll give me huge winners. 60% of my trades will be small losses and break even, which means I have to manage my trades correctly, and I have to get into my trades. All of my trades are always getting at 0.25%, and then I scale into my successful trade. So that's just basically to start off. Today, I want to talk about something that you see on virtually every chart. I've got the euro versus the dollar open here. If you just glance from left to right, yes, we are in a channel, but if you look at the individual candles, you will see a lot of one-bar dojis, okay, a plethora, a lot of these one-bar dojis all over the place. Now, a one-bar doji is a trading range, and whether you see it on the daily time frame or on the 5-minute or any other time frame, it is a trading range. There's a couple of things you need to bear in mind, and I will demonstrate that by example. A one-bar doji is a one-bar trade. A doji, depending on the time frame that you own, is a trading range. So a one-bar doji on the daily time frame, which is what you're looking at, means that there was a trading range. Market went up, market came down, and closed on or near its opening point. Now, the most important thing you have to bear in mind every time you see a one-bar doji is that you have to expect failed breakouts. You have to expect failed breakouts at some point. Now, if we just take this particular one-bar doji, you have its extremes, the low and the high. You have to expect that when we break beneath the low of a one-bar doji, expect a failure on the day, okay? Or if we break above its high, expect a failed breakout above the high. That's number one. The second, that's the first levels where you must expect failures. The second levels you must expect failures is at the measured move of the range of that one-bar doji. So taking this one as an example, immediately I would always put on my charts, there is the measure of the trade of the range of that one-bar doji. There is a measured move. So if I don't get a failure while I'm trading the 5-minute chart on the day on the break of that particular low, that's fine. I trade what I see, so I'll just keep shorting, okay, in the day, and I leave that in there until the market has tested it, broken through it, or seen what's on either side of that. At some point, which was the following day after this bear breakout, here came the failure. So when the market tested that and you've got that in place, you've got to be expecting failure. And if you see a reversal pattern, which I'll be looking for, then you trade it. You know, the market might have gone up, and tested these levels here and reversed down. Fantastic. It came back. It would have come back and did a reversal there. You look for that reversal. Then, surprise, surprise, we also get another one-bar doji. And the same thing, at the extreme of the one-bar doji, you have to expect a failure, and also on that extreme, expect a failure. So if you popped in on this particular day and the market went up, And if you didn't buy because you didn't know what to do, or whatever the reason, you're not in the market, didn't happen during your time, whatever. When it got to this area, the high of this one bar doji, if you were in the market, you have to expect a failure. And on this day, you'd be looking out and you see the market breaking above the previous day, expecting a failure. You would have seen a distinct reversal pattern within there. If you didn't see that reversal pattern, it started tracking down. The other ways jump into the market, then it sold off completely to get to the bottom. Now, this is what is absolutely fascinating. So let's leave that there just to show you how to do it. We always put the measured move of the one bar doji. There is the low of this one bar doji, and there is a high of the one bar doji. So opportunities there if you were in the market to take trades in, then it broke out beneath. And what do you expect? You expect that when the market gets to the measured move of the one bar doji, you expect a reversal. So on the next day, follow through opportunities in there. When the market got to this low, you expect a reversal. We closed with a strong bear trend candle, and the market sold off on this outside candle, which is a trading range, but that's another topic for another discussion. Bit of a failed breakout there, but you still have it. You know that is the measured move of that one bar trading range. So when the market opens the very next day in that area where you're expecting a failure, if the bears are strong, they have to be strong enough to break out beneath this low and carry on all the day, completely eradicate the magnetic pull, if you want, of that measured move. But when you get that kind of reversal and the market goes up in there, if you were working on a Friday, there would have been opportunities for you to jump in. I know there was some news climatic effect at some point, but there would have been an opportunity for you to jump into the market. It is not a surprise for price action traders when you see that. Also, if you look to the left, there's other levels that the market was trying to break through and failed. Okay, and what's going to happen, going off it into this coming week? Let's just put that back in there. There is the measured move of that one bar doji. Why is it still important? Well, it's the first candle of the month. It was a doji. They tried to break out beneath it, failed. If the bulls are strong, they have to break out above this level. They have to break out above the parity, big round number 1,001. Big problem for the bulls. The bulls have to be strong to break out above it. The bears want to make sure it fails. But if the bulls have followed through on this candle, which is higher probability because of the strength of it, they have to break above that. And guess where they are going to meet resistance? There is the measured move of this one bar trading range. So it was already stuck in on my charts. There is a measured move. That's what they need to get over. And if you look to the left, you can see, excuse me, how important that price action is. Another problem for the bulls, of course, is the descending trend line. Yes, we're in a strong channel. Now it's a bit shallower, 2-bar reversal. So the bulls will need to get over above that level. So that's just quickly the one power of dojis. And you can look at that on every chart, and you can see how that works. Always mark the measured moves of the one bar doji. Thank you, guys. We shall see you again, and bye-bye.